So these are the four things we're going to really address today, okay? This is a pattern that very simply starting Monday, you can start utilizing and you can make money from. So we're going to cover four things. One, what are 3-bar patterns? Okay, that's the very first thing that we're going to understand. We're going to take a look at, we're going to try to figure out what a 3-bar pattern is. What is he talking about? Okay. Second, we're going to give examples of what a 3-bar pattern looks like and some variations of it. Now, this is a beginning class, and I can turn this into an advanced class if need be. Third, we're going to go through bullish patterns and bearish patterns so that you can identify the differentiation between all, okay? 4, we're going to give you actual entries and exits and what you should be shooting for as far as targets. So, hey, Jack, good morning. So let's get right into it. So what is the 3-bar pattern? Okay, 3-bar pattern, this is important, is a continuation pattern. It's a technical indicator used to identify trend continuation signals. So what we're trying to do is we're trying to get into a trend and we're trying to stay in that trend. We're looking for a continuation of it. This is not a reversal pattern. Really important concept, right? There are reversal patterns, as we're all aware. The pattern involves 3, and then I have in parentheses 4, because sometimes it can be 4, whose movements indicates whether continuation in the trend is bound to happen or not. Now, the end of this, I'll take questions and we can open it up to everything. So these are standard 3-bar patterns, okay? First bar, you can see. Second bar, you can see. Third bar, you can see. These are your standard patterns, these 4. 1, 2, 3, 4, right? That's it. That's the focal point. They're always not going to be that pretty, but that's the concept that you're looking for, all right? And you should be able to identify that concept and kind of recognize those as failed bullish haramis, failed bearish haramis, okay? So if you think about it from that perspective as a failed bullish harami or a failed bearish harami, right? You know when you fail a position, what it does and how effective that can be. And this is a way to profit from that. Not everyone's going to look at this and know what a bullish and bearish harami are. For those that are, you'll be able to look at this and determine and know exactly what I'm talking about. Now, these are the bullish ones. These are the patterns that you're going to look for, okay, for a continuation of a bullish move, meaning the stock going up. These are a bearish pattern that you're going to look for, okay? And these patterns, very simple, right? You see how there's 3 or 4 bars. These patterns, all we're looking for is for a continuation. And so you can see clear how that would be a 3-bar bearish harami. Now it's not. Now it broke, right? Failed. So by doing this, you can also see that this is kind of like a flag, right? So that's a bearish. Now let's just get into the parts of it. Thanks, Lisa. I appreciate that. That's what I'm trying to figure out. What's the best time? We have a lot of people from different time zones, and I know people have responsibilities and want to enjoy their weekends, but I'll promise not to hold everyone here for more than an hour. Parts of the 3-bar bullish pattern. So they can be tiny flags to an extent, but there's a little more to it. And we're going to get into that. You'll see it in the examples. Parts of the 3-bar bullish pattern. Number 1 on the left-hand side right here. Okay. First bar must be long, green and green. Okay. So let's go through this. So I'm going to be really specific about this. The 3-bar pattern. Okay. The first bar must be long and green or you don't have this pattern, period. Wicks don't matter. In other words, this long green bar, we don't care if this long green bar is a doji. We don't care if it's not a doji. We don't care if it opened at the low and closed at the high. We don't care. All we care about is that range and that it's green. That's all we care about if we're looking from a bullish perspective. The second bar must be in the top 50% of the first bar. Wicks don't matter. It doesn't matter if it's a doji or it's not a doji. We can talk about that later and get very advanced. But what matters is that we want that bar on hold to be 50% or less than the previous bar. Now, we don't always get what we want, right? So we're going to go through examples where it's just not as pretty, but we're going to go, and we'll go through a couple of those. The third bar must not break below the second bar. So the third bar, and this is a pretty hard, fast rule on this. The third bar must not break below the second bar. Okay. There is application versus teaching, but the third bar must not break below the second bar. This includes wicks, and it must clear the second bar in order to be the third bar. Okay. Parts of the bearish pattern. The first bar must be long red, right? Bar. Wicks don't matter. Again, I don't care if it's a doji. I don't care if it's a shooting star. It doesn't matter, right? I like the long red bars better, right? I prefer to have them because it's cleaner and shows that you have a better chance of the probability of the trade working, because it shows the amount of selling that went into it. The second bar must be in the bottom 50%, okay? Second bar must be in the bottom 50% of the range. That's a guide. The smaller, the better. Wicks do not matter. So it does not matter if that 50% is a wick, a doji, or just a long bar. In order for the third bar to fit this pattern, you must not break above the second bar. If you break above the second bar, it's done. The pattern's essentially over, right? It's a different kind of pattern, but that's pretty much like one of the hard, fast rules that I've used. And we'll go through some examples, and some of them might actually have it. And must clear the second bar. So a lot of this is basic, so I'm going over it pretty fast, but I want to go through this so that we get it. Now, these are great patterns, entry, exits, and three-bar patterns. These are great patterns for people that are trying to trade off the open and don't know what to do. And they might not like some of the other patterns that I've discussed before. So this is if this pattern happens, usually it's greater than a 50% chance that I've noticed that the trade will work, especially if they're done accurately. So I like doing these off the open, but you can use this pattern for monthly, daily, minute charts. It really doesn't matter. Entry above the first and second bar. And that's really important to remember. So not only do you need to get above the first bar and the second bar, you have to get above both. And the reason I say that is sometimes you're going to have a bar in the second and you're not going to get above that one, right? And then it's going to take some time and then you'll finally get over that second. So you have to make sure you're above both bars, not just the second one and then not the first one yet, right? So you want to be above the first and the second bar to enter. Your stop is under the second bar. It's not under the body of the second bar. It's under the wick or whatever the low is of the second bar. Okay, that is what your stop is under. So keep that in mind, right? And we'll go from there. Oh, they're just tiny flags. No, and then this is Saturdays are good for me. Good to know. So now that you have the stop under the second bar, we know where our stop is. Your goal on these trades are going to go from our lesson 2 weeks ago. Your minimal goal with this is what we're shooting for. It doesn't mean we're going to get it, but the goal is to get 2 to 1, R to R, right? Risk versus return, our return risk ratio. That's what we're looking for right there. 2 to 1 minimum on these kinds of trades. Okay. So now we know how to enter them. Entry and exit of 3-bar bearish patterns. Entry is below the first bar and second bar. Okay. So when you enter again, it's not just below the second bar. It's below the first and the second bar. It's really important to remember that. All right. Stop is over the second bar. So you want to have a stop over that second bar. And then your goal is to be 2 to 1 risk versus return on the bottom. So you want to be over the first and second bar. You want your stop to be over that second bar, right? So you have to be, so you want to undercut, right? That's what you're going for. And then your stop over the second bar. All right. That's what you're looking for. The goal is 2 to 1. That's it. These are very simple patterns, very, very simple patterns. So that's all I want to go over so that you can grasp it. And I'm going to go through some examples so you can see it. Now, while I'm going over the examples, let me see these questions. So I'll get to that in 1 minute, buddy. But I want to go over some examples, okay? This is not a hard concept. It's not going to require a lot of time, but you should be looking for these in the morning, right? If you're looking to day trade. But let's just start here and let me flip screens now and show you these and give you examples so that you can see them, and then I can take questions. So what we're going to see here to start, the bear pattern is for short. Yes, the bear pattern is for short. So let's just take a look at Apple on the daily. All right. So, and these are real life examples, and real life never mimics what's in a book, and that's done on purpose. The examples that are going to be here. So just FYI. Now, so we have this example here on Apple. So here's my first bar right here. Okay. So that's the first bar, long green bar. That's what we're looking for. Second bar, 50% of this bar. Yes. You're looking for 50% on your second bar. And the reason why you're looking for 50% on the second bar right here is because you're looking for a battle. You're looking for buyers and sellers to put themselves in a position, right, where they're going to fight. That's what you're looking for. Okay. So then you put the trade on. Where do you put your trade on? You put your trade on right here. Okay. And that shows you what your cost would be. Now, one of the great things about these trades, this is where your stop is. All right. So now that we have that mapped out, we know that our stop is roughly what? $2. Okay. So we know what our stop is. Now our goal is then going to be to get $4. So the best way to do these trades is you need to get in immediately. So one of the things that you can do is once this second bar forms, okay, if you're not trading like huge volume or huge size, let's say you're only going to trade like 1,000 shares of this, right? Because you don't want to do anything where they're going to trigger you on purpose. But let's say you have 1,000 shares up here. All you do is put the buy order right there now. That's it. Once this bar forms, you can literally go out there and put a buy limit order so that when this hits, right, or a buy stop order rather, so that when this hits, you get bought in immediately. And that's going to get rid of all your slippage on that move. And then from here, we were looking for $2. I don't even know if we got to the 4 or not. We might not have gotten there. Got the 380. So you got the 2-to-1 on this roughly. But what you want to see when you're doing something like this is you want your order to be right there. Now, this is a very simple trade, right? Very simple trade. All you do is enter and then go. And this is on a daily chart. So this took, let's just say Tuesday, Wednesday, Thursday, you're in, right? You're not moving right away. Thursday, you're in. And then you just go Friday, Monday, Tuesday, you're out, right? So here, this could have taken 3 to 4 days for this whole thing to play out on the daily. So just understand that. So both are the same or different in the aspect of entering the trade. They're both different. Buys and sells are both different. They're different because of how you're going to enter and where your stop's going to be. Again, this is your stop. This is your entry. If you're doing these and you're interested in something like this, you could just put a buy stop out there for the day. Like let's say you have a full-time job and you can't trade all day. Well, if you see these patterns, you can just go out there and put a buy stop order right here. And then when the buy stop order just has a conditional order to put that stop in right behind it, you're done. You don't even have to watch it. And then you just kind of watch it as time unfolds. Maybe you get this, maybe you don't. Maybe you get stopped out, break even. That's up to you and how you're going to trade. But this is how you can get into stocks for a continuation trade. So that is Apple. Now, let's go look on a smaller time frame. And let's go look at something so simple as a 1-minute time frame and see if we can find an example in here where this may have worked. So we're going to blow this up. All right. And so I'm going to get rid of this for a moment. And we're just going to look at this. Now we have a long green bar. So that's the first point. So now we know what that green bar, and the second bar is formed, right? So when that second bar is formed, and we know that that's formed, we know that we need to get in right there. Okay, so if we know we need to get in there, we could go out there and put a buy stop order if we really wanted to. That means so that the moment that it triggers there, that we get filled. So now we're dealing with less slippage. And less slippage is really important on shorter time frames. Okay, because that would get you in this trade for 8 cents. Right? I think that's 8 cents, 6 cents. So we'll call it a dime you're in that trade for, right? In 1 minute, you're trying to scalp. If this is what you're doing, that's fine. But the point being is when you got to this level from here, if you were trying to scalp, you made 2 to 1. Okay. So you still made your 20 cents on that trade, right? In, out. Now, whether or not you held it, you got up here, whether or not you got stopped back out, it's not my concern. That's up to you and how you're going to trade and manage your risk, right? That's different conversations that we've had and how you can do things. So there's definitely different ways to do that. But I want to be really clear about that. The best trades are like these dojis, depending on the time frame. They're shorter because that's where the battle's going on. And then the breakout is exactly what you want to see. So I have a question, and I want to take questions while we're doing this. Entry and exit as soon as the bar crosses. No, do not wait for the candle to close. Do not wait for the candle to close. Execute immediately, right? This is a completely different kind of trade. So you want to just get in. So I actually, to the point where if you're trying to do this particular pattern, I would recommend start getting comfortable with buy stops so that you're in as cheap as humanly possible. Okay. If you're in as cheap as humanly possible, right, you're going to benefit, right? But you need the pattern to set up in order for you to be in that position, right? I mean, that's really what you need, right? It doesn't matter what the pattern is, but if you can get comfortable with these kinds of trades to pull money out of the market, it gets a lot easier. Okay. So just something to think about. But for me, yeah, if I was not trading huge size on something like this, like let's say I was trading 100 shares, 1,000 shares on this, they might trap you. 10,000 shares, they're definitely going to click that on a 1 minute. But if you're just banging around like 100 shares or 500 shares, something, whatever it is, they're not going to come up and clip you and bring it back down. And if they do, your stop's right here. So that's the end of it. I mean, you can literally conditional order these. So you get in and up in them, right? That's all you're trying to do, right? You're just trying to get in and up in the trade. So whether you did a buy stop on here for the daily on, let's say, like the Apple trade that we just went over, right? It doesn't matter, right? If you put the buy stop there and then this conditional order goes in behind it, and then you just look at where your positions are at the end of the day, it's irrelevant. You just let the trade play itself out. Trade's on. There's nothing more to talk about, nothing more to do. Just leave it on. So, but it's immediate. You enter immediately. So there's 2 examples. Both of those are bull. Let's give you another bull example. And I think this one is on the 15-minute. So here we are. Get rid of this. And what you're going to see is, and I want to make this really clear. So if you take a look at this up here, 706.87, 706.93, okay? These are not going to be exact. There are times that you might be over on a $700 stock by a couple pennies. Do not let that stop you from doing the trade. Now, some people might say, I gapped up. I'm on the 1 minute. I would have bought the orb. That's fine. Your stop on the orb is either here when it triggers, right? Or it's down here. So that's a completely different kind of trade. I'm talking about this. Let's say that you didn't do this orb trade, or you didn't buy this off the open and you missed it. You could use and understand these patterns when you're looking for them and realize that there's another spot for you to get in. And this would have gotten you in that other spot, right? So that's exactly what you're looking for, to get up and in a trade. This breaks out right here. Let me show you the entry is right here. Whether you're doing market or you're doing whatever you're doing, 3rd bar triggers. You have to be above the first and the second bar. So you have to look at those prices. That's why I mentioned first and second bar. You have to be above both. You would have triggered on this bar for 15 minutes, right? This would have been your stop right here, right under it. Okay. So you are risking, let's call it with slippage, let's call it $7. So now that you're in from $7, whether you're getting stopped out here, right? Or whether you never got to this level, which is kind of interesting. And you can see how support and resistance flip on that little doji and on that level, but you never got stopped out. So whether or not you're blowing it out up here where you made 20 points, or you somehow got fortunate and you're up here where you got 29 points, I don't really care. I know that I'm not riding this back down to here after I'm up here. So I know that's not happening. So let's assume this, and let's assume that you only got three, you got 3 to 1 on it. Okay. So now let's go through coin. So coin will have 2 different examples for me that I think work. Let me see if I can find them. There we go. Perfect. So let's start here with coin. All right, so this is going to be a bearish example. Now, I want to go through a couple things with this one. Okay. You have to be above the first and the second bar. Okay. This bar and this bar, this might be like 55% or 60% of that bar. Okay. You might not want to do this trade because of that, but it has all the characteristics, right? So we're in a position where you can see this trigger. You can see this doji that's sitting right here too. So you may look at this and look at the overall pattern that you're dealing with, but just playing with this particular pattern and walking you through it, this becomes your stop. So you're going to have to look at that range and see if that makes something sense, if that's something that you want to do, if you're willing to use that kind of range. If the answer is no, then you don't do the trade. Okay. It's really that simple, right? Because you might look at this and go, I don't want to risk, $15. I don't want to do that per trade. Well, then don't do this trade. That's why people like them when they're tighter, because they can control the risk. But if you did this and, I don't know how long you stay in it for, but if you did this trade and you didn't get stopped out and you left your stop there, okay. I mean, at a minimum, you're here, and that's 80 points. So is it worth, right? I mean, at a minimum, let's just say you close it here, 50 points, right? Because you get stopped out on the jump, right? Okay. I mean, is it worth risking $15 to make 50? I would argue that it is. So looking here, that gives you your entry above the first and the second bar. Third bar breaks down. You could have if you have a full-time job, you could just simply have a, sell stop right there. It executes and you sell, and that's the end of it. Now, in regards to coin, there's an example here where we're going to have a bull example. And let me pull this up. And then I'll open it up for questions, and then we can talk about anything. This is something that you just want to start learning how to implement, and you really want to look for them, right? Everything is pattern recognition, technically. That's what it is. So here's bar number 1, right? So this is going to be bar number 1. And we know that that's our entry point. Why? Because here's bar number 2. This is a daily chart. So I know that if this is bar number 1 and this is bar number 2, and I understand these patterns, then I know that if I flip that pattern, I might want to try this. And I might want this to be my stop. So now I'm in there for roughly $7, 4, 6, we'll call it 7 with slippage, even though it's closer to 6, right? So now you have to look at that and go, do I want to do that trade? Well, you might say, I don't believe in this because I'm looking at this dropping. So no, I don't want to do that trade. Or you might look at it and say, yes, I do want to do that trade, right? That's up to you. I can't make those decisions for you. All I can do is show you a pattern, how to recognize that pattern, and tell you that you can do well if you're looking at them. But if you're uncomfortable with the trades, just don't do them all. That's your stop right there. Trade breaks right there. And then you would look at that and go, okay, well, where are we at right now? Well, from this level, and where did we close? I don't know why that didn't. There we go. To where you're at right now. Let's just say that close. So you're up $8. So right now you're up 1 times risk, and we don't know if it's going to go higher or lower, right? We don't know if it's going to go up to here or not. We just don't know. But at least you're up 1 times your risk, and then you can play with the trade from there. You just don't lose money now. It's that simple. Okay, don't overcomplicate it, especially when you're new. Try not to overcomplicate things. Now let's go look at this on a daily and see if we can find something that fits the criteria of a spot. So this is XBI, and then very simple trade. Now we're going to just walk through this again. Okay, I'm going to just state this, which I hope is obvious. I don't care if this second bar is green or red. I just want this one to be green. Right? I don't want a dragonfly that's red. Okay, just FYI. I mean, that's not what we're going for here. So now you have here, and let's draw that in. So here's my level. Now, why am I showing you this one? I'm showing you this one because I'm not buying this bar and I'm not buying that orb breakout. Why am I showing you this one? Because it popped over and didn't stay inside. Because I'm showing you this one because this is not an exact science. There is education and then there's application. So I could look at this and go, you know what? The body's in this one and the wick's out. The wick's a rejection, so I'm not going to buy that. But the moment that I go back over this again and I clear the first and second bar, I'm interested. Right? So my stop actually moves to that level, right? Again, this is not an exact science. This is a daily chart. We popped over. You're using application now, right? Application of the education. So now you're looking at this and going, this is my entry, not here. You must be above the first and second bar. You flip it. This becomes your stop right here, 124. So you look at this and go, okay, I have $2 of risk. How did we do on 2 to 1 from that position? On this one, we would have made roughly 3 to 1. Okay. So that's what you're looking at. There may be pattern recognition to spot these. Robert's question is there pattern recognition to spot these? I'm sure there is. I'm sure there is pattern recognition out there to spot these. I don't know how they're going to spot the nuances that I just went over. So that's kind of the issue for me. Can you run these kinds of charts? Absolutely. There's people that run algos to look at these kinds of things all the time. People that are running algos to knock them down when they break. There's absolutely. But I'm not sure, Robert, I don't know how, because I don't do it, right? That's not how I trade. But I'm not sure how you're going to set up a program that's going to be able to look at this and go, if it gets over this, I want to buy it, right? I don't know how that computer program, Robert, is going to develop an intuition, right? And that's what we're trying to do. We're trying to get you to develop a skill set, intuition, education, right? So that you can basically come out here and innovate your own style. If you put this in a computer program, maybe you could do that. Maybe you could assign something to it with, as long as I'm within this range and I'm only out like 1%, then, identify this as a possibility. I'm sure there's something like that out there that could do that, that you could do that with. I'm sure of it. But that's not really, it's not really how I trade, Robert. But I'm not saying not to trade like that. I'm just simply saying that's not how I trade. So let's go here with the coin and let's do the next one. I hope that's clear. This is coin, right? We just did coin on both. No, that's not yet. Coin we just did, right? Or did we just do crisp? Coin we did. I don't think we did coin. XBI we just did. Now we're doing, okay. I got lost there. PayPal. So PayPal, let's go take a look at a 15-minute. So hopefully you can see what I'm doing here. These are all different time frames, right? And you can go out, it could be any time frame. It could be a yearly time frame, which every bar is 1 year. So very simple trade. PayPal. Here's your bar. Here's your inside bar. I don't care if this bar is red or green, right? You got it? See the break right here? So why am I showing you this one? Because it's application. Okay, there's education and then there's application, right? There's two different things. So you have to look at that and be able to make those decisions. There's a couple reasons why you might not want to do this one, right? There's a couple reasons why you might want to do this one. That's up to you, right? But when you're looking at this, this does not fit the classical definition of a 3-bar pattern. But this is something that makes a lot of sense to execute on for a couple different reasons. Now, here's your entry. Let me just show you this. Pull this down and go here and go, that's your entry line right there. Okay. And this right here is my stop. Okay. That's my stop right there. Now, let's take a look at that. So that gets me 60 cents. Let's call it 70 cents of risk with slippage. I enter that trade. What's the best I would have done? The best you would have done is $3. Let's just say that you waited for one higher high bar before you got stopped out, and that would have taken you right here. And let's say on your 70-cent trade, you made $2.45, right? Because there you are, 3-1. Okay, on your trade. It's over 3. But they're probably out there, Robert, for sure. You're over 50% with these. If you back test this pattern, you're over 50%. So the reason that I'm showing you this pattern is if you just take this pattern and you constantly do this pattern on dailies, monthlies, weeklies, whatever you do, and you use 2-1 over the long time, you're not going to lose money. It's going to be very hard for you to, will you have drawdowns? Absolutely. You could do 100 of these in a row and be wrong. But if you consistently do it and you have enough money behind you, eventually you're going to win. Okay. And that's one of the reasons why I'm showing it. So if you can start implementing this, right, and adapting it to your particular style, whether that style is like what Robert's saying, where he wants to put them into a computer, or whether that's me, where I'm going to look at them and see which ones break the rules, right? It doesn't matter. It matters how you adapt it to your style. Everybody's different. And everybody's going to trade differently. But yeah, if you run patterns on this, you'll see that you're over 50% of the time that this is going to work. It's very, very rare that this is not, to me, that when you see these, that they're not going to work. I mean, they're inside, think about it this way. They're inside bars that then trigger. That's what they are, right? They're inside bars that then trigger. Okay. Most of the pattern recognition that we go over, it works. Like here's that doji, flips that doji, right? That's a morning star. We all know that. And we know that this is the target on it, right? We all know that that's the target on it, right? Because they complete the morning star. So yeah, if you run these and you focus on this, you'll notice that, yeah, the majority will go. Like even if take this right here, right? So here's your 3-bar pattern, right? Here's your entry. Okay. Here's your exit. So now on this one, we're going to risk $1.10. And all we're going to do is say we're going to leave that in as a stop. Now, it doesn't matter when you get out of this. Are you going to ride for this? I don't know. Let's say that you don't. You look for that reversal right there, right? There's $1.60 there. Maybe you just say that's enough. I'm out, right? Or maybe you hang in there longer and you're saying, you know what? I get stopped out or I make 3-1. Depends on your style of investment, how you want to go about it. Some people will say, unless it hits 2-1, I'm going to lose money. I just want to see if I'm right. And that's what they do. They don't even think of moving it until they're 2-1. Everybody trades differently. So you have to find a style that develops for you. But that's one way you can look at it. Now I'll give you one more, and then we could open up to questions, and then I can talk about anything. But yeah, if you run this, if you back test this into like a strategy tester or a back test system, I think you'll be surprised at your percentage on something like this. And then implementing this with other things will just increase your percentage chances. That's all you're looking for. You don't want to be the guy at the blackjack table. You want to own the casino, right? And that means that you have to get the probabilities in your favor. You have to get an edge. So let's look at this on a much larger time frame. Okay, so let's go through this. All right. So here's your pattern. Triggers, right? After you trigger, you don't know that this one's in here for a reason. Let me show you why. You don't know what I'm saying is, let's say you buy this, and let's say that this is day one of the month, right? And then you close out over, and then what happens? And you get stopped out of it, right? Can you go back to it? The answer is yes, you can go back to them. So let's say that you get stopped out, okay? And after you get stopped out of it, it goes higher, right? So this is, again, this is a month. So you have a monthly stop right here. So I enter here, right? I enter when it breaks out because I don't know that it's going to stop me out. And then it stops me out. Okay. So I've lost money on this trade. I've lost $4 on this trade. Okay. Now, when that happens, what do? Well, we're out of the trade. Can we go back to the trade? Yes, we can go back to the trade. Where can you get back in the trade? At the previous high of the third bar. So if I come down here and I get stopped out, I can re-enter up here. Okay, now does that increase my risk? Yes. Will that adjust your position size? Yes. That's when you can re-enter. Now, if you did something like that, just for example, again, this is a monthly chart. So I'm showing you that you can do this on any time frame. And I'm also showing you how to re-enter one that you got stopped out of. Now, let's just say that you entered there in January of 18 and you left the trade on. You've done fairly well for yourself. So are you really worried about that $5, right? You've just got into a stock that you could stay in for the rest of your life. So don't be afraid to re-enter positions. I see that a lot in the room. Okay, I refire in the trades all the time, and I'll reverse positions on the short-term basis. You're all seeing that now, depending upon market conditions. But I want you to take this out. Just because you get stopped out once does not mean that the trade's not going to work. All right, just keep that in mind. Okay, just because you get stopped out once does not mean the trade's not going to work, and that's what I really want you to take home with this one. You can see how that would have been a great example of one that worked. So keep that in mind. Now, I'll gladly take questions on anything that you want to talk about. If you want to go over this, you want to go over something else, whatever you want to do, it's fine with me with the time that we have left. We have about 15 minutes left. Seems better to trade shares and options in these setups. Oh, yeah, you're always better off trading shares. Every time you could trade shares, I would tell you right now, Robert, 60% of the room, we're trading. I think 53% of the room trades options. My last time I surveyed it, right? And I can tell you right now that since we're open up for questions about anything, I can tell you right now that I don't think that the majority of people that are even trading them should be trading them. I really don't. I think they're looking for that quick hit. And Ramona had a really good comment in the room where she's like, until I have mastered trading stocks, I'm not even going to play with them. And I think there's something to that. I think too many people are caught up in options and don't understand them. So, I was a registered options principal for over a decade. So I'm very familiar with options. I'm very familiar how to get hurt on them. And I'm very familiar with how to hedge on options. So, like what some people don't get is, I'll give you a great example. Now, here's Tesla, right? And we're going to put pre and post in. Now, if you're playing Tesla and you're short Tesla, right? And let's say up here and you're short Tesla, when you get up at 4 o'clock, 5 o'clock in the morning, and let's say I have puts that I put on, right? Which we did have at one point, if you go look back at the option expiration, and I open down here, I don't have to wait for this to open to close my puts. I can just go here and buy stock against it. Now, not everybody that buys puts knows how to do that. So I have, to me, I have an edge. I know how to do that. I know how to calculate the delta based upon the drop and the time and everything. So I would tell people that unless you're very proficient with things, you take your option trades and you do it to make a little bit of money, and maybe they work and maybe they don't, right? That's what you should be doing it. You're not in a runaway bull market. We all know that. The reason why I even threw this option out and why you'll see me do it with Tesla more than anything is because people just don't have the money. Like they just don't have the funds to do this with. So, not everyone's going to go out there and buy $700,000 worth of stock on Friday, right? So they can go out there and control or 70,000 or whatever. They're just going to go out there and buy an option, and maybe they lose $300 or $400 on that option over the weekend versus coming in and it's down 20 points. So that's why you'll see me do that. But yeah, I would get more familiar with stocks first. Hey, Jack. Let's say I'm swinging XBI, for example, and I saw that daily doji close. How would you interpret that? Well, so we're just going to talk about dojis, and you can give me the date that you're talking about. We can talk about that. So I'm not sure if you're talking about this doji that I used as an example. I'll assume that that kind of is a doji. So let's get rid of all this, and we'll leave that up for now. I'm assuming you're talking about this. Look, dojis are inflection points, okay? And so you kind of have to pay attention to them. So for me, if I have a doji, I try not to do anything with the trade until it tells me what it's going to do. So like, here's a great one, right? So let's get rid of this. So everyone should recognize this pattern right here, right? You should recognize this. If you don't, we should talk. So you should recognize that as a bearish hook reversal, right, Jack? So if you haven't watched that video, watch it. So these are easy patterns that you should be able to start saying that's this is that. So now I have this doji. Now I don't know, I don't have the rest of this, right? That I know that I'm going to have yet. I just don't know that that's there yet, right? So all I have is this. I wonder if there's a way to block that out. Maybe if I go there and change the properties of that to a color like red or something, maybe that'll help, right? So like that, see that red part that's funneled in? You don't know that you have that yet, right? All you have is this. So what is that going to do for you? Well, dojis are uncertainty. The long-legged dojis are massive uncertainty, right? But we know that they're wicks of price rejection. So we failed to make that higher high here. Here's your doji. Here's your entry price on that bar, right? On that doji. And here I am here. Why would I do anything until that doji makes a decision? But once that doji makes a decision, right? I open here, I run up, I'm convincing myself how smart I am by not putting the trade on, right? And then it triggers, boom. And then you look at where you're at, a month later from that one trade, right? That's what I'm saying. Like some of these, you'll start learning this as you start playing longer. You just let things like work themselves out. Like don't be in a hurry. If you're nailing it and you're making money, just let it go. But you nailed this. So $3, you made 20, right? So you made, a decent amount of money. You made, 7 times your money, right? Remove the segment line. So, something, you just got to let them go. I'm going to go into a tangent. So, on something, but there's no reason to act on that doji, Jack. Like there's no reason. So I want to go off on a tangent on something just so like we get it. And you understand this. So commodities I've been trying to preach, they're boom bust cycles. Okay. This is breaking down. We entered, I think it was $10 on this little break right here. Right. So I know this little pattern. I like these patterns when you're breaking these lows. They're perfect for me. So when I saw this break, okay, and I calculated out what my risk versus return was, I have a fairly decent short position in this. I've done nothing with it. I haven't scaled out of any of it, done nothing. So, there are times, let your winners run until you see a change in their behavior, right? When you see a change in your behavior is when you should be cutting, not just because you want to lock it in because you made X. If you're locking things in because you made X, you're never going to make Y, right? Like if I didn't give this doji this opportunity to work when I cut this whole BPT trade, if I didn't wait for this, right, for it to finally close below, if I didn't wait for that, I had a problem. So I have to give it room. I have to allow it to run. And just, so think about that, on your trades. Yesterday's close on XBI. Was yesterday's close on XBI a doji? Yeah. So what do you do with that? I mean, to me, it's very telling bar, right? This is my interpretation of that bar. This is complete rejection of selling. This is my inability to get above the opening price after a huge move up, which we are now up from here, right? And this is kind of important. I should probably walk through this. See how you have this Morningstar pattern right here? See how this Morningstar pattern clears the other pattern? You're only supposed to go to here and you cleared it. See how this one did it as well? When you start seeing that, pay attention to that, because that means that obviously you have buying pressure, way more buying pressure than you have selling pressure. Anyway, so you just moved up 21% in 2 weeks, 6 trading days. So, a rest is not unrealistic for this to pull back and to go into other sections. I would identify where I'm at and where that stopped at, and I might see if there's a bonk level there, right? Bonk, 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 right? You can see that in there. So then the question is, well, what do I do with this bar? What else is it telling me? Well, it's telling me this is price rejection, but it's telling me that we had buying all day long after it rejected. They bought it up and they tried to get it as close to the close as possible. So I would wait and see how this plays out before I did anything. This makes it a lot harder if you're trying to preserve capital, right? Because you're looking at this and going, do I really want to give $3 up? That's up to you, right? So you could look at that and go, do I really want to give up 4% of this move, right? If I give up 4% of this move and I made 20%, right? I'm giving up 20% of my profit. Do I really want to do that? And the answer might be no. No, I don't. Right? So that might just be, okay, I'm going to close it out. Meaning if I get below this close, if I open below the close and there's one tick below, I'm just going to get out of the trade. And it might be the wrong thing to do. And it might go a lot higher. But you're going to do it anyway. So that's my thought on it.